Moving over to the carbon side of things, we got a fair amount going on there. We've looked at this chart in the past, but this is looking at hot roll coil prices in the white line. We've got Northern Europe prices in the blue line, and then we have Chinese prices in the orange. And regardless of the market, they're going at different extents, but you can see a bit of a rollover in the price of the last couple weeks of data. Perhaps the leader of all of this is really China. Down there in the orange line, you can see, despite the fact that they're easily the cheapest market within the world in terms of the main manufacturing centers, they were kind of the first ones to actually start to roll over. And maybe we should have been watching this chart as a proxy for identifying the fact that China's manufacturing economy just is not yet ready for prime time. It's not yet coming out of the doldrums. And you can see that within the price there. And that number is very heavily discounted to where Europe is, which is right around 850, but also admittedly looking like it's plateauing, maybe rolling over a little bit. And then here in the United States, which had the biggest rally, arguably the best end market demand as well. We saw prices run up from 650 all the way to 1200 on a hot roll. We're beginning to see that turn a corner and head back down. Was a little surprised, and I think some of my colleagues were a little surprised to see that this week's CRU actually went higher by a couple dollars. Usually within the carbon markets, they tend to be kind of big money in, big momentum one direction, and then big momentum another direction. To get a little bit of a head fake this week is a little interesting. And when we look at kind of customer activity, when we talk about hedging with customers and things like that, we actually are seeing quite a few customers kicking the tires on steel futures right now. I think that's a function of things being relatively okay in most end markets still within the carbon side of things. But that being said, it does look pretty evident that the trajectory of spot prices in all three of these regions is heading lower. And unfortunately, because we've had the biggest run up in the last couple of months, perhaps the move to the downside could be the largest within the US as well. Want to touch quickly on capacity utilization, because this has been one of the contributing factors for why we saw prices domestically run up the way we did, because there was so much responsibility or I guess prudence within the supply side of the equation by domestic steel producers. Despite the fact that prices went up from 650 to 1200, steel mills were very prudent about keeping production levels constrained. And you can see that within this chart that, yeah, they've recovered a little bit. And we are now back above 75% of all productive assets now making steel. But when you look at it on a 5-year basis, it's certainly not suggestive that mills are going gangbuster and producing more and more tons. So they're being somewhat responsible in making sure that supply and demand conditions remain relatively balanced, which is fairly interesting. Now, I talked about the price trajectory of steel. We're looking at steel futures here. The blue line is going to be 6 months ago. The orange line is today, and then the green line would be from a month ago. And what I find it's almost comical is the back end of all of these curves have almost not moved at all, despite the fact that the front end of the curve has moved by $500. So what you had is basically a phenomenon where even though prices went from 650 to 1200, the futures market said, this isn't going to last, this isn't going to last, this isn't going to last. And here we are on the back end of all of this, and it looks like we're coming over the edge of the roller coaster, and we're heading back down into something lower than where we are. Are we going to get down into the low 800s as the chart suggests? I don't know. That's a pretty aggressive move from where we are right now. And admittedly, we are seeing end demand markets look okay. But that being said, it is worth noting that Steel Dynamics Sinton plant down in Texas, they're producing steel, perhaps not at the clip that they want to be, but they are beginning to ramp up production. You've also got AMSA out of the Mexican markets, which has gone through a sale to a private equity firm. They've infused a couple $100 million into that mill, and their expectation is that sometime in late Q3 they're going to begin ramping up production. So those are some of the things on the supply side that could cause prices to further correct lower. And I think some of that is built into the futures market. But like I said, we are seeing a lot of customers kicking the tires and saying, low 800s, mid 800s. Some of those numbers don't look too bad for locking up our business. And by no means is this financial advice to say that that's a good number, but it's certainly a heck of a lot lower than where we are right now. And we've seen some interest from customers in recent weeks.
As long as we've been doing this, and as long as you've been showing that chart, like I've never seen it flatline like that. I mean, so if I'm reading that right, so these are the three different, you have May, April, last November, if you would have bought in, right? And that's kind of where they all kind of even out and converge for now through 2025.
Yeah, you're calling me out on my BS, and I appreciate it. Part of this is going to be a function of, if you're a consumer of steel, you're not even thinking about late 2024 yet. You're not thinking about 2025. Some of this is a function of most of these markets all the way out on the far right side of the chart. They haven't traded a whole lot because most businesses don't require you to have a steel forecast for 3 years or 2 years out in the future. But that being said, I will say if we look more in kind of the middle left area, maybe that February 2024 area, those contracts would be trading. Maybe not to the quantity that the 2023 months would be, but they certainly would trade, and those haven't moved a whole lot either. So yeah, I acknowledge your observation, which is those are very, very straight line. They're perfectly flat. That's primarily a function of some market maker, some trader had to come up with a price, and they just straight line that price because it doesn't trade. But if we look on the more nearby futures, which would be January, February of 2024, those ones really haven't moved too much either. So I think that is how they're deriving those long-term prices to make their assumptions.
Got a question from the audience here. Have imports started making their way back into the domestic markets?
It's interesting, a little bit, not to the quantity that you would suspect, which maybe I should have pulled a chart on this because that was one of the contributing factors for why we saw prices run up the way we did. Yeah. But I do think a lot of, my gut says a lot of consumers, whether it's service centers or end users, I think there are a lot of consumers that are a little skittish right now. And obviously they're seeing prices sky high back around $1,150, $1,200. Even though you might be able to get a little cheaper on import, I think the fear is if your lead time on import is 5-6 months into the future, there are some concerns that, particularly when you look at the futures market, there are some concerns that if you bring metal in, put it on a ship, you get it here come August, September, those tons might be underwater. So the procurement of import tons has been less so than I would have suspected on the carbon side, unlike what we talked about on stainless, where I think the gap is big enough that people are bringing in some.